Picture yourself as an investor in 1998. The internet's taking over. New companies are sprouting everywhere, and every investor is convinced they've discovered the next revolutionary opportunity. So you dump all your cash into tech stocks simply because they've got those catchy .com names attached. For a few years, your portfolio keeps climbing higher and higher. Everyone's calling you a genius until the year 2000 hits. Nothing's short of breathtaking. A points drop never witnessed before on U.S. markets. Traders and investors completely shell-shocked. The Wall Street collapse wiped out $1.8 billion from the world's richest man in just 1 week. When the bubble finally popped, the Nasdaq plummeted nearly 80%, and only 48% of .com companies managed to survive. I witnessed countless friends lose millions in the blink of an eye. Even though I'd been half expecting this crash, my own investments still took a serious beating. The internet genuinely was the next revolutionary technology. But even with that reality, the overconfidence and hype manufactured one of history's most catastrophic bubbles. Why am I sharing this story with you? Because jump forward to today, and I'm feeling that identical energy all over again. This time, though, it's not the internet driving it, it's AI. People are labeling it a once-in-a-lifetime opportunity. Maybe they're correct, or maybe we're watching the exact same narrative unfold once more. History doesn't repeat itself, but it sure rhymes. Every generation believes they've stumbled upon a brand new era. As John Templeton famously said, the 4 most expensive words in investing are, "This time is different." But is this time genuinely different? Since over 7 million of you have begun investing because of my videos, I feel obligated to share my honest perspective on what's unfolding right now. Before you start panicking, let's step back and examine the 3 hidden forces driving this potential bubble, why they're crucial, and what you can actually do to benefit from all this chaos. Right now, the destiny of the entire stock market and your portfolio is being determined by just 7 companies. They're called the Magnificent Seven: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Combined, they now represent roughly 36% of the entire S&P 500. They're all locked in a fierce arms race to dominate artificial intelligence. Even if you only own a single share of the S&P 500, you're already placing bets on these companies. Whether you realize it or not, your future returns hinge on how this competition unfolds. Every dollar these companies pour in creates ripples across the entire market. From chip manufacturers to power companies to construction firms building data centers, all flowing back to your index funds. When you see how much they're projected to invest in AI, you'll grasp why people are beginning to whisper the word bubble. Let's break them down individually. Tesla's planning to spend $5 billion on autonomous driving and xAI, which is Elon Musk's new AI startup. Apple's committing $10.7 billion to make Siri smarter. And if we're being honest, it'll probably require more than that. Meta's dropping around $60 billion on data centers and their broader AI initiative. Google's investing $75 billion rebuilding the internet. With AI, Microsoft's pouring $80 billion into funding OpenAI and supercomputers. Amazon's spending $100 billion through AWS to control the infrastructure everyone else depends on. That's roughly $330 billion total in just 1 year. To put that in perspective, that exceeds the entire GDP of countries like Finland or Portugal. All that capital is flowing into building the future. Some are even calling it the 4th Industrial Revolution. I understand the excitement, but here's what makes me nervous. A significant portion of this spending appears to be what's keeping the economy functioning right now. Without it, the U.S. might already be experiencing a mild recession. The question becomes, how sustainable is this? It doesn't appear to be stopping anytime soon. Global AI spending is projected to hit $500 billion by the end of 2026. Spending on power and resources connected to electricity demand could surpass trillions annually by 2030. That's how desperately these companies want to dominate the AI arms race. I understand why. The International Monetary Fund estimates roughly 60% of jobs in the developed world are exposed to AI, meaning they could be transformed or partially replaced in coming years. Whoever cracks this technology first gets rewarded with something more valuable than money. They get leverage, they get influence, they get power. Mark Zuckerberg even stated that if Meta ends up misspending $200 billion, it's still worthwhile, because moving too slowly means they're eliminated from the competition. This race isn't just between companies anymore. It's between nations. The US and China both view AI as the key to global dominance, and they're both burning through billions to ensure they're the ones holding the reins. For everyday investors like you and me, this can play out two vastly different ways. If AI delivers on its promise, the next decade of investing could resemble the internet boom. Enough to lift almost everything. But if the profits don't materialize quickly enough, the same stocks inflating your portfolio today could deflate it tomorrow. That brings us to the real question. Where's all this money actually coming from? When I first understood what I'm about to reveal, my mind was completely blown. But before we continue, if you're finding this valuable and you've been subscribed for a while, I want to mention something I created called the Buffett Academy. It's where I share exclusive weekly videos revealing the exact stocks I'm purchasing, how I'm thinking about valuation, and the millionaire blueprint I wish I'd had years ago on building wealth. If you want to invest in yourself, you'll find the Buffett Academy linked below. Now back to this. What you're looking at is being called the AI money machine, and it's the primary reason I've started getting concerned about the state of the AI industry. Let's erase some of these arrows and walk through how it actually functions. Intel, AMD, and NVIDIA are the companies designing the chips that power AI models. OpenAI and xAI, plus numerous smaller players, are the ones purchasing the chips. Then you've got companies like Oracle and CoreWeave, these data center operators that also purchase chips, then rent out the computing power to the AI companies. They're essentially the middlemen. At first glance, none of this appears crazy. It's simply business. But once you examine how these companies are funding each other, the red flags start appearing. It began when Microsoft and its partners injected massive funding into OpenAI. OpenAI then pays Microsoft back to utilize their data centers. Microsoft then uses that revenue to purchase NVIDIA chips. NVIDIA then invests money back into the AI ecosystem. Doing this enables multiple companies to record that flow as revenue, which can inflate valuations higher because markets love revenue growth. It's kind of like if I went into the woods with a friend and paid him $1,000 to dig a hole. Then he paid me $1,000 to fill it back in. We both still have $1,000, but now we can both claim we generated $1,000 in revenue. If investors valued our digging and filling business at 40 times revenue, suddenly we'd appear worth $40,000 each. Obviously, I'm simplifying. These companies aren't literally just circulating the same exact dollars, but the core concept remains identical. It's gotten even more extreme recently with headlines surrounding enormous infrastructure deals, like OpenAI partnering for massive amounts of compute capacity and data center companies responding by spending tens of billions more on NVIDIA chips. Then NVIDIA invests into parts of the ecosystem, and the ecosystem purchases more NVIDIA chips. NVIDIA sells to everyone: Microsoft, Meta, Google, Amazon, OpenAI, Oracle, and then it can also place capital back into the same orbit that maintains demand strength. The problem is that can start resembling guaranteed demand, even when the end customer profitability isn't proven yet. See how messy this becomes? Let me simplify it even further. NVIDIA sells the shovels. The data center companies provide the land. The AI labs dig the quarry. They're all helping each other construct the mine, even though we haven't fully proven how much gold is actually down there. That leads to the biggest issue I see right now. AI services aren't making enough money yet. OpenAI is valued like a company printing cash, but it's still burning massive amounts of money every month. The question becomes, will these AI companies ever generate the kind of profit needed to justify their stock prices? The honest answer is it's possible, because they still have some enormous levers they can pull. Consider the scale. Hundreds of millions of people use AI tools weekly. That's an insane amount of attention, and even more importantly, an enormous amount of data about what humans want. Imagine the moment these platforms start enabling ads, or the moment they let companies plug directly into the conversation and recommend products inside the chat in real time. That could be unlike anything we've ever witnessed before. On top of that, AI companies are constructing systems aimed at undercutting the human workforce. They're betting that once corporations become dependent on AI, they'll have no choice but to keep paying, regardless of the cost. If businesses become hooked, if AI becomes as essential as email, then the companies providing it could eventually raise prices and finally cash in. So yes, there's no question these AI companies are valuable. But much of that value still depends on one thing, the belief that progress will keep accelerating. And that brings us to the next hidden force. AI has been improving at breakneck speed. For the past couple years, we've progressed from AI video that looked like a weird dream to AI video that can actually fool people for a few seconds. It's funny that Will Smith eating spaghetti became one of the ways we measure AI improvement, but it also proves the point. The stock market is relying heavily on that rapid improvement continuing, because if AI keeps getting better, companies keep spending, investors keep believing, valuations keep rising. But we're not far from hitting something people call the data wall. For years, AI has been consuming every scrap of public data available. The concern is that at some point, we simply run out of high-quality human-generated online content to train on. It's like climbing a ladder in a game of snakes and ladders. Everyone assumes the ladders keep going, but if you run out of ladders, suddenly you have to move square by square slowly. When markets are priced for speed, slowly is dangerous. Just think about how long some of these datasets took to build. Books, research, art, code, recorded human knowledge, centuries. No wonder progress looks so rapid. AI has been fed a giant buffet of human output all at once. If the data wall is real and progress slows down, expectations could collapse, and the bubble investors are banking on could finally burst. But here's the nuance. Is beating the data wall possible? Potentially, yes. Because humans don't learn only by being fed data. We learn by interacting with the world. We learn by making mistakes. We learn through experience. That's something AI doesn't naturally have. AI hasn't lived your life. It hasn't had your conversations. It hasn't felt what it's like to make a dumb investing decision and regret it. In my opinion, scaling past the data wall isn't just a question of more data. It's a question of different data, new kinds of data, data created through interaction, simulation, robotics, real-world feedback loops and systems that can actually test things instead of just predicting text. If AI companies crack that, the ceiling gets much higher. But if they don't, then we could see progress slow, spending shrink, and valuations re-rate fast. Look, I'm not a scientist. Let's bring this back to investing. I started this video by comparing what's happening now to the dot-com bubble of the late 1990s. No, not entirely. This is important. The biggest difference is that AI is real. It has real utility. There's a clear path to profits. How big those profits will be and who captures them, that's still the open question. But it's a much better situation than the dot-com era, where some companies got insane valuations just because they had a website and a catchy name. Does that mean it's not a bubble? Honestly, I still think it might be, because the signs are there. Overvaluation, financial engineering, geopolitical mania, scaling limits, and the most dangerous one of all, the belief that this time is different. But here's the hard truth. There's no way of telling what stage we're in. This could be the start of a decade of insane innovation and massive returns, or we could be closer to the end than people realize. First, keep investing. If we're still early in this cycle, the prices you see today could look cheap in a couple years. That's why one of the smartest moves you can make is setting up an automatic investment that leaves your account every month and goes into a broad, low-cost index fund. I did this during the dot-com era. Even though my investments took a hit when the bubble burst, I don't regret it, because over time, the market bounced back. Historically, it always has. The real secret isn't predicting the crash. The real secret is not panicking when it happens. As long as you're investing in a fund that tracks the overall market, continuing to invest through a downturn can be one of the best financial decisions you ever make. That's how people quietly made fortunes after the dot-com bubble popped. But to do that, you have to make sure you're not over-leveraged. You have to make sure you're not drowning in debt. That's exactly why some people got wiped out in 2000. They didn't just lose money in stocks. They lost money in stocks while also being forced to sell because they had bills, margin, debt, and pressure. Second, focus on increasing your income. Your income is the fuel that grows your wealth. If you can increase it through a promotion, a better job, a new skill, or a side hustle, you supercharge everything, especially if the market falls. Because when stocks are down, every dollar you invest buys more shares. That's how downturns turn into opportunities. Not because they feel good, but because they reward consistency. Third, focus on diversification. Putting all your money into one type of investment is a recipe for disaster. The key to surviving bubbles is being diversified. That means spreading your money across different assets, stocks, bonds, real estate, maybe precious metals like gold. And for some people, even a small amount of crypto, depending on risk tolerance. It's also worth considering dividend-paying companies because during downturns, cash flow matters. Even when prices are ugly, dividends can keep you in the game. The last thing I want you to remember is this. If this bubble bursts, it won't be the end of the world. It will feel scary. It will feel like the headlines are screaming. It will feel like everyone is running for the exit. But if you understand what's happening, you won't be the one panicking. You'll be the one preparing, and you'll be the one ready to take advantage of opportunities and stay ahead of the crowd. Now, if you want a deeper framework for what I'm doing personally in markets like this, and you want to see the exact stocks I'm buying and why, that's what the Buffett Academy is for. You'll get the millionaire blueprint for building wealth. If you want to join, it's linked in the pinned comment below. Finally, if you found this video useful, do me a quick favor. Smash the like button, subscribe if you haven't already, and turn on notifications so you don't miss what's coming next. Because whether AI is a bubble, a boom, or both, the biggest mistake you can make is being unprepared. All right, I'll see you in the next one. I wish you all a great day.